I don't think there's a lot of downside risk in gold. I mean, obviously, there's a little bit of an opportunity cost in that you're giving up your interest, but there's not that much interest, and I think the upside potential is enormous relative to the downside risk in gold from here. I think historically, if you look at where gold is relative to, let's say, U.S. stocks relative to the Dow Jones, with the Dow Jones, close to 40,000, and gold at 2,000, gold is historically very, very cheap. Gold could be 10,000 or 20,000 with the Dow at this level.
The price of gold has been a focal point, currently hovering around $2,027. The backdrop of this valuation is shaped by robust U.S. economic data, prompting analysts to scrutinize the factors influencing precious metals. Notably, the prevailing sentiment suggests that as long as expectations for a downward adjustment in interest rates persist, gold and silver will likely grapple with continued pressure. Peter Schiff, chief economist and global strategist at Euro-Pacific Asset Management, asserts that gold is historically inexpensive compared to U.S. stocks, particularly in light of the elevated valuation of the Dow Jones nearing 40,000. In contrast, gold is priced at $2,000. Schiff anticipates a substantial surge in gold prices. His rationale hinges on concerns surrounding the money supply, existing inflation, and the specter of future inflation. Examining the economic indicators, the U.S. M2 money supply stands at $20.77 trillion, experiencing a marginal uptick from last month, but a decline from the figure 1 year ago. Correspondingly, the inflation rate in the United States rose to 3.40% in December, with projections indicating an expected rate of 2.80% by the end of the current quarter. Schiff's view on gold prices perfectly aligns with these signs, highlighting the delicate interplay between money-related factors and inflation. A critical aspect of Schiff's narrative revolves around the potential shift away from the dollar as the primary monetary reserve by central banks. If this happens, it could lead to a renewed interest in gold. The consequence: there is a likely increase in demand for gold, pushing its prices to levels we haven't seen before. The recent trend of global central banks buying more gold supports Schiff's argument. In 2022, their net purchases hit the highest point since 1950, making it the 13th year in a row with such buying activity. Schiff's assertion gains momentum as he highlights the limited supply of gold. In the face of heightened demand, a significant increase in its price becomes almost inevitable. This aligns seamlessly with projections from Trading Economics Global Macro Models and analysts, foreseeing gold reaching a trading price of $2,089.21 per troy ounce by the quarter's end. Join us as we delve into insights shared by Peter Schiff. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
I think that gold has built a very big base around this level. It initially rose to around 2,000 in 2011, and then pulled back to 1,000, and then gradually made its way back up again to 2,000, and it's kind of been hanging out around this area, and now it's been building a bit of a base just above 2,000, and I think we've been compressing the support higher, and the resistance is there, but I don't think it's very formidable at around 2,100 or 2,150 or just above. A lot of people are still a little reluctant to buy gold above 2,000 because they've been burned in the past at this price point, to see gold pull back. But the pullbacks have been, narrower and narrower. And I don't think there's a lot of downside risk in gold. I mean, obviously, there's a little bit of an opportunity cost in that you're giving up your interest. But, there's not that much interest. And I think the upside potential is enormous relative to, the downside risk in gold from here. I think historically, if you look at, where gold is relative to, let's say, U.S. stocks relative to the Dow Jones, with the Dow Jones, close to 40,000, and gold at 2,000, gold is historically very, very cheap. Gold could be 10,000 or 20,000 with the Dow at this level. If we're going to get to a cheap stock market, which is what I think. I mean, right now we have a very expensive stock market, based on valuations and a lot of other metrics. I don't think the market should be expensive. The market should be cheap, and eventually it will be cheap, but it won't be cheap in dollars. It'll be cheap in real money. It'll be cheap in gold. But the other reason I think gold prices go much higher is, money supply and inflation. And not only how much inflation we've already created, but how much inflation is going to be created. The last time we saw a move that I think is going to be similar to what's coming is in the 70s. Because in the 70s, the price of gold had been suppressed for a long time, and it went from $35 an ounce in, the late 1960s to over 800 in the early 1980s. I mean, think about the magnitude of that rise, the percentage gain. And so think about where gold prices would be now or later if they did something similar. And what happened in the 70s, of course, is we left the gold standard, and the result was a big devaluation of the dollar as a result of us leaving the gold standard. Well, I think the next major move is going to be when the world leaves the dollar standard. And when that happens, when the dollar loses its role as the reserve currency, I think the next markdown in the value of the dollar relative to gold could be just as big, if not bigger, than what we had during the 1970s. So that is a huge potential increase as the world remonetizes gold, as central banks now move away from dollars as their primary monetary reserve, and they go back to gold as their primary monetary reserve. And that means they have to buy a lot of gold. And that also means everybody else is going to be buying a lot of gold, and there's not that much gold to go around. So the only way to make it work is with a much higher price. And I think that's what's coming.
PeterSchiff points to a significant trend, a global shift away from the dollar. This movement is perceived as a response to economic imbalances, with countries actively exploring alternatives. According to Andy Schechtman in an interview with Kitco News, this is a huge deal. Saudi Arabia is the linchpin to the dollar hegemony. Whether it emanates from the BRICS or from within, the day of reckoning is coming. Adding fuel to the narrative of a changing monetary landscape, there are reports that the United Arab Emirates is distancing itself from the US dollar in oil trade. Instead, it's exploring individual oil and gas deals with up to 15 countries, transacting in local currencies. PeterSchiff introduces an intriguing proposition amid these shifts. Schiff proposes that gold could replace the dollar as the world's reserve currency, significantly as inflation erodes the dollar's purchasing power, making it an unsustainable choice for global reserves. One noteworthy indicator of this potential transformation is the behavior of British countries, with a particular focus on China, indicating a shift away from U.S. treasuries in favor of gold. Notably, China takes the lead in this recalibration, actively bolstering its central bank reserves through significant gold purchases. Let's get back to the interview.
The dynamics do not favor the dollar as the reserve currency. Remember, when the dollar became the reserve currency, initially, number one, it was backed by gold. And it wasn't just backed by gold, it was redeemable in gold. But also, the U.S. was the world's largest creditor nation, and we were the world's largest net exporter. We had huge trade surpluses, and we were this gigantic creditor. So it made sense. Everybody needed dollars because everybody wanted to buy our stuff. We made all the cars. We made all the radios. We made all the appliances. I mean, all the manufactured goods were made in America. And so people needed dollars to buy all our stuff. But flash forward to today, we're the world's biggest debtor. We have the world's biggest trade deficits. What do anybody need dollars for? No one needs to buy our stuff. We don't make the stuff. Right? So people have been recycling these surpluses into our debt, into our bonds. But we owe so much money that it's obvious that anyone holding our bonds is holding the bag. They're going to take losses. So it doesn't work. And we have these global imbalances, huge economic imbalances, because Americans live beyond their means. We spend, but we don't save, or borrow, we don't save. We consume, but we don't produce. And this is a gigantic burden that we have imposed on the rest of the world that has to subsidize this. And the cost is getting higher and higher and higher. And so it's got to come to an end. And I think we accelerated the process early in the Biden administration with these sanctions on Russia, where we weaponized exorbitant privilege that the world has given us against Russia. We made an example, and we basically a warning, hey, if you own dollars, you better do what we tell you. Or, we have the ability to punish you. And I don't think China is happy to be in that position. I don't think anybody wants to be in a position where the U.S. has that kind of power. So I think we've created another political incentive on top of the economic incentive to de-dollarize, to move away from the dollar. And, one of the things that happened early on in the 70s when we went off the gold standard, that's when we got Saudi Arabia to price oil in dollars. So, okay, well, you couldn't get gold for your dollars anymore, but at least you can get oil. We created the petrodollar. But, the world is moving away from that. I mean, more and more trade in oil now is occurring in other currencies. And so this process, I think, is going to accelerate in the years ahead, as this, debt bubble explodes and we have to go back to QE, whatever we call it, in the face of escalating inflation. And then people realize that 2% inflation is a thing of the past if we ever actually had it, and it's going to be high inflation or double-digit inflation as far as the eye can see, and that means negative real rates on treasuries and U.S. debt, and nobody's going to want to hold it. And so then you're going to get this unraveling of the dollar, and then there's no way the dollar can be the reserve currency if it's losing that kind of purchasing power. So there has to be a replacement for it, and the most likely alternative is gold. A lot of people, and it's very conceited, but people think that, well, the dollar will be the reserve currency forever because there's no alternative, because the euro is not a good alternative, the yen is not a good alternative, the RMB is not a good alternative. So there's just no choice. The dollar wins by default. Well, we don't need another reserve currency. We could just have gold as a reserve.
Gold price kicks off the new week on a weaker note and stalls a 2-day-old recovery trend from the vicinity of the $2,000 psychological mark, or over a 1-month low touched last Wednesday. Is $2,000 gold the new price floor en route to $2,500? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.